Hi, I'm Mark Hammond, Utah's mortgage broker, and I'm here to tell you my role in the crash of 2008. In 1994, I was graduating from college in Utah. I noticed a small ad in the placement center for a job for a mortgage company, and I'd always wanted to do real estate, but I thought mortgage might be more my style because I did a business minor and almost an economics minor. The company was called New World Mortgage, and they were specializing in hard-to-do home financing, the beginnings of which would later be termed subprime lending. I got the job, and many thought I was crazy to get a degree and then take a job making straight commission. But the company was great. I had had great training, and I learned the business quickly. And I worked long hours establishing clients in a state where I didn't have any connections because I grew up in California. But my wife and I had just had our first baby, and we decided to stay in Utah. Back in 1994, there were a couple of retail finance companies like Beneficial and Abco that would do home loans for people with small dings on their credit and would charge really high rates to do them. And they would let us charge a broker fee to bring them clients. There wasn't any place else to go. There also started to be a few wholesale lenders that we could use that would allow some lates on the credit and still do a mortgage, and they'd charge about 12 to 15% interest. There were also local private money or hard money lenders that would lend around 65% of the value of the home with no questions asked, and they'd charge about 18% interest. Rates on conventional and FHA loans at the time were around 8%. A loan program was created called the 2-year fixed variable. Ford Consumer Finance was one of our lenders, and they would charge 11% for 2 years, and then would go up to 13% and be a variable rate from then on. We did tons of those. Average price of the homes back then was about $120,000. We ended up buying our first home for $82,000 in Sandy, Utah. We would typically be doing debt consolidation for people, paying off, say, 28% interest credit cards, and reducing their overall payments by hundreds of dollars per month, consolidating their debt into a simple interest mortgage at like 11% interest for people whose credit was too bad for a conventional mortgage. Here's how we got our leads. We would network with other lenders that didn't allow these types of options and didn't have any interest in pursuing them. I'd walk into a bank or a mortgage company and I'd say, I'd like to talk to someone about your loans. And the receptionist would immediately find me someone to talk to. And I pitched that we could close their loans that they had turned down and pay them a 1% referral fee. Paying the referral fee is now totally illegal, but it wasn't back then. And I did this all over Utah, and would literally walk out of offices with armloads of stacks of files that they had turned down. These files all had borrowers' personal information in them, W-2s, tax returns, social security numbers, and they just give them to me, sometimes only having met me just then. It blows my mind to think of how crazy this was for identity theft, but it wasn't even a thing back then. Then I'd call through all of those files and find the ones that would work. We didn't use credit scores back then as they were just starting to be developed. We had lender reps that would come to our office and bring bagels and these complicated rate sheets, and they would break down the rates based on the percentage of the home's value needed, the number of mortgage lates, installment lates, revolving credit lates, liens, judgments, collections, the type of property, occupancy, and the type of income verification. And we'd have to figure out all these things, find out what the interest rate would be, and if they'd even qualify based on all of those things. Human underwriters made the decision, so we had to work with the borrowers to write credit explanations for all of the derogatory credit and why things are better now and why they should get the loan. More and more wholesale lenders started to enter the field and try to outdo the competition by allowing more late payments, recent bankruptcies, foreclosures, and even foreclosure bailouts, and less income verification. LTV means loan to value ratio, the percentage of the home's value they allow you to borrow based on your risk. At first, these programs would not lend more than 70 to 75%, which means that you'd need to have 25% equity left in the home after the loan was made. But this slowly crept up as lenders competed for the business. Income verification also got more and more lenient. Just for self-employed borrowers at first, self-employed borrowers have always had a hard time borrowing because lenders use a 2-year average of their net income to qualify, which often isn't enough. Lots of personal expenses can be claimed as business expenses, so their incomes look lower than they really are. So lenders started allowing us to use 24 months of deposit averages on their bank statements. And then they started doing it with 12 months, and they'd take out an expense factor. These got more and more lenient, and soon they started just accepting stated income. First for the self-employed and then for everyone. Someone working at McDonald's could state that they were making $10,000 per month because they had a side business established with the state, and some lenders would just accept that. Many of these loans had what was called a teaser rate. The rate would be 2% lower for the first 2 years, then go up 2% after 2 years, and then would be a variable rate. So it could adjust every 6 months based on certain parameters and the market fluctuation. The teaser rate seems kind of predatory in retrospect, but people didn't want the fixed rate because it was much higher, even though they were offered it. And the rate being lower for 2 years gave borrowers time to fix their credit and have a lower rate during that time, and hopefully refinance to a 30-year fixed conventional or FHA before the rate went up. These teaser rates were sometimes very close to what they could get on a conventional loan that they didn't qualify for due to their credit or their income. So they were great for people that had a hiccup in life. Some people that have late payments, a consolidation could help them lower their overall payments and start paying on time again. For many, it worked great. But for some who couldn't pay on time and couldn't control their spending, they became addicted to tapping into their home's equity every few years to make up for their bad spending habits. Equity in the homes kept on increasing, though, and providing a slush fund for extra spending, and people took advantage of it. You can blame the lenders if you want to, but nobody forced people to sign these loans. They were a godsend for a lot of people that were down on their luck and needed lenders to be flexible. I was headhunted in the year 2000 by one of my referring lenders to head up the alternative lending division for Norwest Mortgage over the state of Utah. It was a great job at first with commissions and salary. Norwest had bought all the first interstate banks in Utah and so had 25 branches. Then they bought Wells Fargo and took their name. A year later, Wells Fargo now bought First Security Bank, a huge Utah bank that had 100 branches in Utah. So then all of the loans turned down from all of those 125 bank branches and also from 7 mortgage offices and over 100 loan officers all came to me. It was like a bonanza of business, and I had to hire people to help me. I'd take a loan application, and I'd get off the phone, and I'd have 15 to 20 voicemails. I also serviced private client services for Wells Fargo, and their special loans for high net worth clients if they ever fell out over there. We also had a joint venture with Ivory Homes, and I did lots of work for last-minute turndowns on their builder deals. I was busier than I'd ever been and had trouble sleeping due to how organized I had to stay to keep up with the service on all the referral partners. Soon I felt overwhelmed with all of the administrative duties, the traveling for meetings, endless emails, trainings, and just wanted to do loans and work with clients, which is what I love. I lost a lot of clients to brokers because their rates were better than the bank's rates. I asked my regional manager why our rates were so high, and he said, if we had the lowest rates, we wouldn't need you. Meaning the bank they counted on me to sell their higher rates to their clients so the bank could profit. In 2003, the only thing you needed to do to form a mortgage brokerage was to pay $250 to the Division of Real Estate. No testing had been developed for licensure yet, so it was easy to start your own company. So I gathered up my nerve, quit my stressful, well-paying job at Wells Fargo, paid $250, and started Legend Financial Services. I called it that because at the time I was also doing life insurance and investment planning services along with mortgages. I soon abandoned those other services, but the name remained, Legend Financial Services. And boy, did things start getting wacky with lending programs. The loan to value ratios, the percentage that we could lend on the home's value, kept creeping up and up for worse and worse and more derogatory credit and income. One program was called the no doc, which meant no documentation. We literally put no job on the application, no income stated, no assets verified. So basically, fog a mirror and you could refinance. For a purchase, no assets were verified, and we could go to 95% loan to value on those no doc loans, or 5% down. But the 5% wasn't even verified. So people were writing on the purchase contract that they'd paid 5% already to the seller as earnest money and getting away with putting nothing down. And we could do things like carpet allowances and concessions of money directly from the seller to the buyer. And so people could actually walk away from doing a no money down purchase with thousands of dollars in their pocket. Can't do that anymore. And nowadays, down payment funds are rigorously documented to prevent sellers or interested parties from contributing and to prevent money laundering. And get this, there were also some second mortgage programs that lent 125% of value. So sometimes when borrowers had a lot of debt to consolidate, we would go to 100% loan to value on a first mortgage refinance and consolidate their debt. And at the same time, we do 125% second mortgage on top of that. So basically, we would lend $125,000 on a $100,000 house. Just pure insanity in retrospect, but just normal stuff back then. And to make things even easier to qualify, lenders offered interest-only loans. So the payments were even lower because they didn't include any principal. And lenders weren't even requiring down payment on investment properties that were non-owner occupied. I bought 2 fourplexes at the same time for no money down with a stated income loan, which today would require 25% minimum down and, of course, fully documented income. Crazy stuff. So what caused this wanton disregard for sound lending practices? Is it my fault because I offered the best solution the market had to offer to people to own a home or to help them make ends meet? No. The real fault lies with irresponsible deregulation of the banking industry, which allowed for all kinds of derivatives and hedge funds to be created around the lending industry, which insured against defaults and were wildly profitable. So profitable, they created a giant demand for mortgages, and the quality of the mortgages didn't matter because they were insured. Ease of financing created demand for houses, which caused inflation in prices, which caused investors to buy houses and even sell them in just a few months for a profit. So builders built houses to keep up with that demand. And in 2004, the Fed raised the interest rates to control inflation, as they do. And millions of Americans had their interest rates go up on these loans that were fixed for 2 years and then variable. And so millions defaulted. And that oversupply of houses under these new rates caused demand to fall. Now houses were finally going down in value, which caused even more people to stop paying on their loans and because they owed more than the house was worth. And the insurance on these loans couldn't keep up with the defaults. And bank after bank and lender after lender started to file for bankruptcy. The house of cards began to fall. So we started seeing people bugging out of their houses when they owed more than they were worth. Some people in this situation would see a house down the street that was bigger than theirs and worth less than what they owed on a smaller home. They'd buy the new house and say they were going to rent out the existing property and use the rents to qualify for that new house, which we would allow, no problem. Then they'd get into the new house and they just stopped making the payments on the old house because it had negative equity. They called this phenomenon buy and bail. And to combat this, lenders stopped allowing people to use rents to qualify on the old home unless they had 25% equity in the exited property. Before all this shit hit the fan and the crash happened, I was doing pretty well financially. I was just a one-man shop doing my own loans and working directly with borrowers, which I love. So I wasn't making ridiculous money. But in 2007, we decided we could easily afford a bigger house. And our 4 kids were in their teens, and our house started feeling crowded. So we kept our existing home and rented it out for and bought a 5,200 square foot house for $620,000. Everyone I knew in the business were living in huge houses, and we finally decided to level up. Bad mistake. In 6 months into that house, the crash happened. Every day I got an email from the mortgage implodometer, a watchdog for the catastrophe, that showed all the mortgage companies that had filed for bankruptcy the day before. Every day there were several, and the lists got really long. All the lenders I had worked with were folding before my eyes, and home prices were dropping all over, and people just stopped applying for loans. I didn't make any money for like 6 months. My wife hadn't worked outside the home for 15 years. I did everything I could do to pivot and try to earn a living. It was the scariest thing I'd ever faced. We started to make our mortgage payments with credit cards and did that for several months until I just said, this is crazy. We can't keep this house. My wife and I were stressed out big time and we were having trouble with our relationship. I tried to focus on the main necessities and not worrying about making the big house payment anymore. But this caused so much anxiety because we didn't know what was going to happen. Our lender that we had on the house got in big trouble and got taken over by the FDIC. You know that insures your deposits at the bank. So after having not paid the mortgage for several months, we stopped hearing from anything from the lender. No mail, no warnings, as if they forgot about us. Sounds great, but it didn't reduce the stress because we knew sooner or later they'd come calling. Eventually they did after about 7 months of no contact. So for a year, we lived without making a payment. Then we started looking for an investor that would buy the house from us and rent it back to us and then buy it back later. We tried really hard to make that happen and had a couple of takers, but both eventually backed out. But this allowed us to prolong the process of foreclosure for another year. Every time we'd submit a purchase contract to the lender, they'd stay the foreclosure or they'd stop the process while we worked out the purchase. So for 2 years, we lived in a house without making a payment until we finally did a short sale, which is where you find a buyer at a lower price than what you owe and ask the lender to allow a short payoff in order to get the house sold. So we sold the house that we bought for $620,000 for $400,000, and we moved back into our house that we had been renting out and have lived there ever since. During the crash, I was able to secure an FHA license, which was hard to do for a broker in those days. This gave me the ability to do FHA loans, which were the most lenient loans out there and allowed me to survive. Many brokers could not pull that off, and I had some friends that were brokers that with medium-sized companies that couldn't get the license because they were too overextended with office space and high overhead. I worked from home, so I ended up taking over 2 companies and about 25 loan officers during that time, allowing them to have a funding source and also made a small profit on each of their loans, which kept me afloat. These were tough times and they lasted for many years, but I kept plugging along and never gave up on my business. And 15 years later, I'm still making loans and helping people achieve homeownership and offering the best products the market has to offer. As an owner of a mortgage brokerage, I have an advantage over banks, credit unions, and big mortgage companies because I get my rates from the same sources, but I don't mark them up like they do. So my rates are always lower. And 30 years now of experience means you get the best person working on the most important transaction of your life. I'm Mark Hammond, and my phone number is 801-808-MARK. I'm the first stop when you want to buy a home, refinance, do a reverse mortgage, or a home equity line of credit. Call me.